Hello, Smart Money Tree podcast listeners. Welcome to the show. My name is Kirk Chisholm. I'll be your host, and today I'm joined once again with my good friend Doug Hagerin. Hey, Doug.
Another happy Friday to you. Hopefully my Friday is a little bit more relaxing than last Friday, Kirk. I was in training for 2 days, and I left training at noon on the Friday, and immediately picked up my daughter and drove 4.5 hours to a soccer tournament. Then we had soccer tournaments all Saturday, Sunday, and then drove back on Sunday. The life of a parent, right? So for all of you out there listening, I'm sure you can relate to the crazy that it is of having basically tweens and teens and hauling them from one thing to the other. It's the life of a taxi driver, aka parent.
You know, what's funny is I thought when the kids are really small and they had to truck them everywhere, and I was like, oh, it's going to get better. And as they get older, it actually doesn't.
No, not at all.
Because they have more, like when they're younger, they don't demand anything. You're just like, I want to go to Disney World. Sure we are, honey. Sure we are, right? But it's like, I want to go see my friends. And you're like, all right,
well,
I got to go. It's like, can't you drive yourself? No, you're only 13.
Well, what I've realized is how much we put on ourselves as parents, right? So we had to load these kids up with activities and do this. They don't remember any of it. Like all the stuff that we did when they were little, it's gone in. It went into that mash cortex of theirs and then just went into a pulp of nothing. So it's like, why did we spend all this time doing it? I keep praying and hoping that some of those experiences just embedded somewhere into their chromosomes, and that's feeding them subconsciously today. But consciously, you're like, hey, do you remember that? No. Like,
there is, Doug. There is a solution to that. It's called TikTok.
Yeah, TikTok. It's anything I want them to know from then. The new experience, I can just pull up some video someone's doing. So
yeah, if you want to see some crazy person doing a crazy dance and somehow that's going to make us smarter, then that's the way to go. Actually, it's funny. I have to say, I feel like, I don't really pay attention much to politics because there's not much I can do about it. But, every time I see like this new TikTok bill, like it seems on the surface like it's supposed to be a good thing. And when you actually read the details, it's like, holy crap, the government can basically just take your company away from you. That's not good. And yet somehow that passed and no one seems to have given a crap because it's got TikTok on the top of the bill. It's like, all right, more freedom. See ya. And I don't even need a tinfoil hat for that because that's not even tinfoil hatish. It's like, see you later, freedom. I don't need that.
It's unfortunate because it's and this is not to take political sides because we're not trying to get political here, but it is what it is. It's just the way government bureaucracy runs. Be careful of what you hear on the surface of anything that's going through Congress, because if it's at the least benign, what they say that they're actually going to do, there's probably 6,000 other things of pork that's thrown into it for something else you didn't see coming. And then when it's something like this, where they're saying, oh, it's net neutrality, or it's, I forget what the bill was called that's supposed to be attacking against the ills of TikTok. Listen, at the surface, TikTok has a lot of issues. There's there might be security issues. There's stuff that's documented, but that's not the end result of that legislation, because here's what happens with anything that gets through, Congress, is that it's usually ambiguous enough to be able to be molded into a number of different ways by the executive branch, which is, of course, their job is to enforce that. And then so what happens is it ends up morphing into something much different than even the intent. I remember one of the senators between the Dodd-Frank Act, and I was listening to Dodd. Now, again, whatever side you believe that is coming out of his mouth on this one as a politician, but he basically told the story of how the Dodd-Frank Act started with one little thing and then snowballed into something that by the time the vote occurred on it, nobody involved with the beginning of it knew exactly what was in it anymore. And yet they're forced to sign the stuff after what? They say, hey, we're going to have a vote tonight. Here's the bill. Where they have 2 hours to look at it and vote on something that's 800 pages long. And you expect that they're going to know everything that's in it? Yeah, well, careful. Be careful what you're asking for.
Yeah, it's like the famous Nancy Pelosi quote of we have to sign this in so we can read it. Right, like we have to vote on this. We have to approve this so we can read it. It's like,
it'll go way too quickly if we don't. And it's kind of like bookmarking Twitter. It's like, I got to grab that before it refreshes my screen.
It's and it's crazy, and we bring this up. We're going to tie this back to investing, by the way. But we bring this up because it's happening too frequently. Like, for an example, like there's a fiduciary rule that passed recently that is supposedly going to require all these, insurance salespeople and brokers to be fiduciaries on retirement plans, and while on the surface that seems like a good thing, right? That seems like a good thing. Like Doug and I are fiduciaries, so when we're advising people, we're fiduciaries, and so everything we do, we can't just take off our fiduciary hat like some people can. Like it's permanently on there, so that's a good thing, right, for people like us because we're fiduciaries all the time. But what it's requiring is requiring other people to be fiduciaries in association with retirement plans. Now, you might say, well, what's wrong with that? And this gets into like how we look at things, right? Because we talk about chart crimes. Like a chart crime is just a story put into a chart format that's telling you a kind of narrative. And if you change the time frame, if you change the metrics, all of a sudden it's a different narrative, right? So you always have to like wonder why things are being framed. So the fiduciary rule, like it's a great idea. Here's the problem is that you have this battle between the SEC and FINRA, right? And of course you got insurance companies too, but I'm not going to bring them in here for a second. You have SEC and FINRA, right? Like you've got the fiduciaries, right? And this is our rules. Like, hey, we're fiduciaries. Like we don't care. Like we're doing the best thing by clients. But then you got FINRA, which is not held by the fiduciary standard, right? And so there has to be a suitability requirement, right, in order to sell somebody something. But once you sell it to them, there's no more requirement. They can, it could be garbage after that, and that's their problem. That's the investor's problem. So it's a different standard, right? And so FINRA wants the standard to be lower because their brokers have to sell stuff, right? And the SEC wants the standards to be higher because they want people to be fiduciaries. Here's the problem I see. It's not that those standards are different because they are what they are. And honestly, I'm okay with that because I'm on the fiduciary side. Everybody else can go pound sand. I don't really care what you do. But here's the problem is you have two government agencies, right, which are seeking to increase their power by getting bigger budgets and getting more power, right? It's just the nature of government. And I'm not chastising either one of these agencies. They do a good job. That's not the point. This has a point with they're seeking more power. So if they're requiring other people to be fiduciaries, either they're going to merge and these standards will be diluted for everybody, which would be bad. Or if FINRA wins and they dilute the standards, so our standards are lower, which I think is kind of a crappy thing to do. But that's inevitably what would happen, right? Because the brokers are not going to fall under fiduciary standards. It's not plausible based on how they do things. And we're not selling products, so we don't need their standard, right? Like we're already held to a higher standard. So there's kind of this misconception between both, like, whoa, you should do it our way. It's like, how about you just keep things separate and you manage your own team in the way you want to manage your team? The fiduciaries are already fiduciaries. If you want to make someone else a fiduciary, that's great. But don't try to suck them into the fiduciary bucket when they also have all these other standards they don't have to appeal to. And now you've just muddied the waters and you've made it a lot more confusing for the consumer. And frankly, you might have watered down the standards for the other people. So this hasn't happened yet. This is speculative, but as you know, people listen to the show. I'm very kind of forward thinking in how I see things, and so I can just see. First of all, this is going to get. I think the lawsuit's already been filed, and I'm sure this won't even come to pass. Like it'll be rejected because of the lawsuit. Anyway, the point being is, if it ever came to pass, what inevitably will happen is a combining of agencies, a dilution, and probably more oversight. That's required on advisors that's completely unnecessary. So I just don't see this as being, a great forward thing. Go ahead, Doug.
Yeah, I wanted to add one thing because you made me think of this. One of the challenges to tag on to the whole implication of a fiduciary standard by policy and kind of what's the way we're doing it has to be you're doing it. It actually creates some immediate fundamental contradictions in the way certain entities do business. So those that fall under FINRA have historically been called the broker dealers. Okay, so broker dealers, again, they make product, they make investments. It's, the whole idea behind it was going to be your major wirehouses in the past who created investment opportunities, packaged them together, and sold them. Okay, which you can argue whether there's good or bad or how they do it, and they do it and they get commissions, and they get paid off it, and make tremendous amounts of money. So there's obviously a goal to push that down. The fiduciary standard says that you obviously have to do what's in the client's best interest. But the broker-dealer model has always been suitability, number one. They also have internal rules that say you can't sell away, which means that effectively, if I'm working for one of those broker-dealers, I have to sell what's in my butcher case. I'm a butcher. I sell steaks. I don't sell salad. I can't even tell you about a salad. I can't tell you that there's a place down the street that might sell you a different cut of meat than we offer. It's not allowed. Okay, this is not me. I'm just using this as a story.
Yeah, it's a great analogy.
So basically, you could go into them all the time, say, "I want, what do I want to eat?" Vinny goes, "Hey, we got good steaks tonight from grass-fed beef." You're like, "Great, you eat it." Come back the next time, and you say, "Well, I'm hungry tonight, so we just made these fresh sausages." Great, I'll eat those. Eventually, you go to the doctor. The doctor says you've got high cholesterol. Right? It's like, "What are you doing?" He's like, "Well, I don't know. I eat at Vinny's all the time." It's like, "Well, if you thought about eating a salad." Vinny's never told you about the salad. Now, does this mean Vinny's a bad person? Not at all. He's a butcher. He's there for meat. But here's the problem with the fiduciary standard. You're now telling Vinny that Vinny has to tell you about the steaks at the other butcher. He has to tell you about the salad at the other butcher. He can't just be a butcher. Sometimes you just want to buy Vinny's steaks. But the problem is the fiduciary standard says you have to tell that. But internally under the broker-dealer model, they still have what's called selling away, which means if they speak up and if Vinny tells you about the steaks of the other butcher, Vinny is fired. So here we have an application of a law that was being put down on an entity that was a bunch of butchers that are selling steaks, and maybe you don't like the way they sell their steaks, but internally, they still can't, by their own legislation, recommend you look at somebody else's steak. But yet, by the new law, you have to. So how do you make that decision? Because unfortunately, you can't. You can't recommend away, but yet you can't be best interest by only recommending what you have. This is where laws get fundamentally, they create a fundamental stranglehold on the ability to function in everyday common sense thinking and working together. It's a good purpose they're trying to implement, but at the end of the day, the application of it, unfortunately, can stall the ability to get anything done.
There was a great podcast I listened to, and I hate selling away on my own podcast, Doug. But
at least you're not going to get fired for it, or
yes,
fined.
No, I won't. My boss is mad at me right now, but I won't get fired for it. So what's interesting is I was listening to this podcast, and it was with Salim Ismail, who I guess was the CEO of Yahoo at one point. But anyway, he's one of those like thinkers, right? These visionary thinkers. And I was listening to it when he was talking about the trends. Like there have been trends of centralization, decentralization, back and forth over time, and right now we're in a centralization state. But the future is in decentralization, right? If you think about, and this kind of gets back into the investing piece. Like if you think about it, like government tries to consolidate power. It's just the nature of it. It's set up to consolidate power. So it's like, if you don't spend all your budget, you're going to have less of a budget next year. So you might as well spend it. Let's go find things to spend it on, right? And you think about institutions, right? Nonprofits, educational institutions. What's the point of an educational institution? We need to make more money so we can spend it down the line on education. Do they? Not necessarily. I mean, Harvard's in the middle of Cambridge. They don't need that much more money. There's only so much they can grow. That, between Harvard and MIT, I think they own like 60 or 75% of the city. Legitimately, those two institutions, I believe, own between 60 and 75% of the real estate in the city, which is crazy. And there was actually a thing a few years back where the city was complaining because they couldn't get tax dollars from these institutions, so they bartered a deal so they'd give them something. But like that's not a positive direction in institutions, right? Harvard doesn't need to get bigger. It's the second largest nonprofit in the world behind the Roman Catholic Church, I believe. I think they're still second. But anyway, you've got these institutions with all this money. What are they doing with it? And their whole goal is to get bigger, right? And they're, which in a sense I understand, right? If you have a nonprofit, let's say you're feeding the homeless and you're trying to make money and you're always trying to raise money, like there comes a point where if you have enough, it'll feed itself. So then you don't have to keep raising money every day. But then there also comes a point where it's too big. And once it becomes sizable, then it becomes inefficient. And then they're just trying to maintain themselves. So if you look at, and I forget the website, but there's a website you can look this up. If you ever give money to nonprofits, go to this website and look at the ratings. And they will rank these nonprofits by how much money actually goes to the cause. And I believe the Pan Mass Challenge is like over 100%, and I don't know how they do that, but basically it's one of the ones that I've participated in the past, and like 100% of everything they make go to Dana Farber plus some. But then you go to some other ones, and I can't remember offhand, but usually the like police union, fire union, there's usually a bunch of those where like 99% of it goes elsewhere other than the cause. And for this one, and I'm not going to name one because I don't have it in front of me, but I'm going to say I've seen this before, where it was like some sort of policeman's retirement fund. Basically, the way it works, and if you've ever gotten this call from a cop, they call you and they're like, "Hey, how's it going?" They try to like connect with you, and they're like, "Hey, by the way, we're raising money for the police retirement fund in your area just to make sure the fallen cops." And they come up with some story. Well, the way it works is if they get $1,000 from you, they get $990, and the $10 goes to the actual fund. So basically what it is, it's a way for the retired people in that, the policemen or firemen or whatever the cause is, for them to make big commissions on the cause. And it's basically everyone knows about it because they're just like, hey, we're just going to help you make a few extra bucks in retirement. I know you need it. Why don't you cold call a bunch of people and see what money you can raise? And it all goes to that person as commissions. A lot of nonprofits do this, and if people are interested, I'm happy to put a link to the session in the notes. But a lot of nonprofits do this. I've seen them where they get these professional fundraisers in where they raise a bunch of money for the nonprofit, and a huge chunk, like 50, 60, 70%, goes to that rep. So their nonprofit's getting very little. The point being is, once you get to a certain size, these nonprofits, and here's my, I always love coming up with ideas. But the one thing you'll never see is you're never going to see a law passed in this way, but it should be, is that nonprofits above a certain size should pay taxes as if they're a taxable entity. 100%. Harvard, MIT, Roman Catholic Church, whoever, it doesn't matter. All of these big entities should be paying taxes. 100%. Now, should the smaller ones? No, I've already said absolutely no. The smaller ones shouldn't because there's a certain limit. But you have to come up with a number where that limit is. But it's certainly not at 5 billion, right? If it's maybe like 100 million or 20 million, I don't know where the number is, but it's not at the high end of the scale. These people should be paying taxes. So if we want to hunt for taxes, stop milking the rich. Milk the nonprofits that are just sitting on that cash and not doing anything with it. They're not helping people. It's just sitting there in a portfolio investing in private equity funds, doing nothing. So,
Kirk, between education and the Roman Catholic nonprofits, which then, of course, is also several of the Catholic schools, you just had Boston turn you off en masse.
Yeah, everyone in Boston just blacklisted me. I got somebody outside picketing. I think I see a Maltese cocktail in his hand right now. I mean, it's like Boston doesn't take crap from anybody. So I'm sure my office is going to get raided or firebombed or whatever. Anyway,
I love that you mentioned all the nonprofits areas that are supported by pretty much the Boston population.
Well, that's what I know. That's what I know, Doug. I don't know your area. I could rail on you too, but you got your own.
Yeah, pretty much here too. But that's the thing. I think people have to understand: as a nonprofit, it sounds good because it usually nonprofit is tied to whatever spiritual entity you belong to, or it's tied to giving and support and charity. So it has that feel good to it. But people often forget that nonprofit doesn't mean, they're not making money and that people aren't getting extremely wealthy on it. It just means at the end of the day, they can't report a profit. So it's not a for-profit business. So you want to understand how much nonprofits generate and how wealthy someone can get off a nonprofit. Go look up some pictures that are out there about some of the pastors, Joel Osteen, and their housing complexes that are out there. I mean, they're worth millions and millions and millions of dollars. the income of the CEOs of some of these nonprofits. I know that, and I'm not going to name any specific names of
Charity
non.
Navigator. That was the name of it.
Yeah,
Charity Navigator. That's the site you can go to and pull up your charity and you can research it.
Excellent site, and it'll be an eye opener for anybody that wants to go through it, because I know a lot of people, and if you tend to be at least mildly guilt ridden, you're gonna probably have some unfortunate surprises when you start to look through who's on this list, how much is going to it. I'm not going to name names, but there's a nonprofit that's very common, is a very common shopping center and place for donations all over in almost every community. Go take a look at how much this potential entity's CEO makes per year, and how little actually it's not even really there to support a lot of charitable endeavors. They will talk about it, but at the end of the day, it's easy for people with the haves to give things away and get a tax credit. And ultimately, it's easy for them to resell those things that they didn't have to pay a dime for right back at you at 10 cents to the dollar. I'm sorry, I was going to say pure profit, but it's non-profit.
Yeah. No, anyway, I know we're going to get canceled for this segment, but honestly, I mean, where we're going with this is, if you think about the superficial view of how you see what you're doing, right? Whether it's donating to a charity, whether it's investing, whether it's your politics, whatever it is, we're not telling you what to think. We're telling you how to think. And the point being is that our whole world, it used to be where you trusted people. You're like, oh, this is a trustworthy thing. But when you do any amount of research, you realize that there's a lot of superficiality to it, where it's really not meeting the needs of what you intended. And so I was raised this way because my dad was a criminal defense attorney. So I don't really trust anybody on the surface. Like, I was just raised that way. And so I just have this deep seated, initial skepticism of everything. And not just saying I don't trust people. Of course I do. But I have this deep seated skepticism of everything. So when I go into it, I looked at it with a skeptical lens and say, all right, what is going on here? And I can see, and because I get these emails a lot, like, how are you so good at this? I'm like, honestly, it's because I was raised, like, I'm always looking things skeptically, like, all right, the TikTok bill, like, oh, well, that's easy. That's an easy thing to vote for. Is it? Like, think about it. Like, what is it actually doing? And what are the second and third degree repercussions, right? Like was the Patriot Act? Well, you're not a patriot if you don't vote for this. And like, I mean, you got Ron Paul out there who's a Republican, and the Republicans passed it, of course, because they had the majority. But it was like, oh, you're not a patriot if you don't pass this. I'm like, yeah, but I'm pretty sure there's some stuff in there that you're not going to like. And of course, years later, waterboarding and all that. It's everything. Every time you say, well, it's a no-brainer, it's like, is it? Is it really a no-brainer? Because I'm pretty sure it's probably not that simple. When you got 50,000 pages of pork in there on the one thing that everybody wants, and they just stuff all this other garbage in there. It's like making a sausage, right? Like, oh yeah, we have this little bit of beef in there shoved with all this other crap we were trying to get rid of. As my science teacher called them, lips and assholes when you eat hot dogs. But anyway,
hey, congrats on taking a full circle back to Vinny the Butcher.
Yeah, thanks. I'm definitely taking this show down the wrong road. But anyway, so we're going to pull this into reality stuff that we can talk about. But I just wanted to say this because every week we try to just give you examples of why you need to be skeptical, why you need to look beneath the surface, why when you see something, you should always say, huh, isn't that interesting? What am I missing here? Right? And you should always say that. You should always be skeptical about everything, right? This is a public service announcement. Have you ever played the lottery? My state advertises that you can't win if you don't play. What they don't tell you is that the lottery is a tax on people who are bad at math. How many lottery winners have you met? Probably none. If you don't like your chances of winning the state lottery, you're definitely not going to like the chances of winning the inflationary lottery. The inflationary lottery? That's right. Your chances to win the state lottery might be 1 million to 1. But you're guaranteed to win the inflation lottery because it affects everyone. And the prizes stink. But here's what you're going to win. Higher prices at the store, shrinkflation in your packaged goods. Higher heating prices to heat your home. Who doesn't want to win that lottery? Much like the government, I feel bad that your costs are rising. So I want to help you out by giving you some free money. It's not a lot. It's only 1 million Zim dollars, but it's something. Well, you can't buy anything with it, but it does look good as wallpaper. And if you live in Europe, you might even be able to use it to heat your home this winter. If the lottery is a tax on people who are bad at math, then inflation is a tax on people who are bad at economics. I want my listeners to be better at economics. So I'm giving my loyal listeners free money. Go to www.moneytreepodcast.com/free money. Follow the instructions to get your free money today. I have a large audience and a limited number of these currencies. So let's make sure we get yours before we run out. Go to www.moneytreepodcast.com/free money. Follow the instructions and get your free money today. So 2 weeks ago, we had the Buffettopia, and everyone went to see Warren Buffett, and I think he has currently right now $189 billion as of Q1 in cash.
He's cash poor.
Yeah, I mean, here's a guy who, and the only reason he's got that much cash is he can't find anything to invest in. It's crazy, right? He can't find enough to invest in, which is why he has that much cash. That should tell all of you, what are you doing, right? And not saying he's right or wrong, but I'm saying that he's got a standard that has done well in the last, 40 plus years. And, I'm not sure that I love everything he does, but it's interesting, right? It's something you can look at and say, all right, he's doing this. What am I doing? If I'm doing the opposite, maybe I should second guess what I'm doing. Right?
And Berkshire has beaten the beloved S&P 500. So, I mean, obviously what he's doing is working. And by the way, that $180 billion is a $19 billion increase from their cash balance in just fourth quarter of last year. So that's a $19 billion, a 70% increase since 2022, but $19 billion added just in one quarter. And it is also, and this is the real mind-blowing thing, it is larger in cash. Their cash balance is larger than the market cap of Starbucks and Target combined. That's larger cash than two of the most, well-known, largest capitalized companies in the world.
I notice he's not buying Starbucks and Target at the same time. He must not think too highly because he got the cash to buy them. And he will. He's the kind of guy who will buy 100% of a company. And
Starbucks is plummeting right now in stock. This would be the kind of time that all of a sudden Warren would swoop in and probably buy it 20% cheaper than it's showing on the market. That's what he does.
Yeah, it's interesting, and I think as we kind of look, we're going to kind of bring this into a few areas that we wanted to talk about. One is here's one. So when we look at, let's see if I can blow this up. All right, so here's a chart of global gold demand, and what I want to point this out. We're going to bring this into the investment realm. We're going to talk about some commodities and what's hot and what's not. But global gold demand, if you look at it 2 years ago compared to today, there's a certain segment that's going to the central bank, certain amount that's going to jewelry, certain amount that's going to investment, and a certain amount that's going to other. I'm not sure what's another, but this source is Goldman Sachs, just for those of you. Take that for what you want. But the point is what it's showing is that the central bank amount, so the jewelry amount is approximately the same. The investment amount has shrunk, but the central bank account has demand has more than doubled. So if you look at this and you say, why is the central bank buying up so much gold in the last 2 years? And this is global demand, so I assume this is all central banks. Mm-hmm. So, I wonder why they're doing that. Are there things that they're concerned with? Could it be inflation? Could it be confiscation? It could be a lot of things, but the point is I don't have the numbers in front of me, but I'm pretty sure it's China and Russia. They're buying up most of the gold. And I saw an article I don't have in front of me, so I'm not going to say this for a fact, but I'm pretty confident that China and Russia make up a big part of that increase in demand. So that should say, what do they know that I don't? personally, listeners know that I like gold. I'm not a gold bug, but I certainly think it should be a part of a portfolio. Um, but if you kind of look at gold and if you look at commodities right now, commodities actually, we had a surge in commodities relatively recently. And we had a surge in energy up until April. And then that started to peter off. Natural gas has actually picked up a little bit. That was in the toilet for quite some time and is starting to come back. If you look at some of the softs, they've also declined in the last 2 months. Cotton's gone down. Cocoa prices they've come down off their highs, but they're still really high historically. Sugar's plummeted, lumber's plummeted, coffee's plummeted. Although coffee,
Are you showing any graphic there,
I'm
Kirk?
not. No,
Okay,
I'm. Let me just
just want to
show
make sure.
those. Yeah, no, thanks, Doug. I should
Sure.
probably show those. I was mainly just focused on the just kind of running through for the listeners. But let me pull this up. So here we go. All right. So if you look at cocoa prices, you can see they've run up big and they've actually sold off, but they're still high. Like historically, they're right around 4,100. Right now, they're at 8,700. So it's still double, but it's not as high as the 11,500 price. Look at cotton, that's come down a lot, although historically it's not bad. It just came off the peak. So we did have a spike in commodities. Sorry, we had. Where we had orange juice, we had coffee, the same thing. We had a spike up and down. So here's sugar. We had a fall off. Here's the thing I want you to think about. So in the last year, there have been narratives out there, right? And everyone's like, tech all the time. Tech's great. I'm going to do tech. And of course, tech's done, the big seven have done marginally this year. Half of them have been doing great. Half of them are doing terrible in comparison. And so it's been kind of like a hodgepodge, but the great ones are doing much better than the ones that are doing terrible. So it's they've still done well, but it's been a different environment. So what's interesting, and this is the lesson you should take away from this because no one's talking about this, is if you look back in history. So when I started, there was this concept of stocks, bonds, and commodities. I know, imagine commodities was an investing asset class. It had been for decades, stocks, bonds, and commodities. And since the 2000s, no one talks about commodities anymore. What are they? Really? You can invest in those? Back then, it was just a part of portfolios. Now it's like, oh, you can have managed futures. Yeah, but that's not really commodities. That's really just traders. That's really just trend following and whatever they're doing. But actually investing in commodities, there was a time where that was a part of your portfolio and it was important. Nowadays, it's not because interest rates are so low that no one's interested in commodities. And you can tell commodity prices have been actually rather low for the last, I don't know, 20 years. But if you look at rising interest rates and you look at some commodities which have started to pick up this year, especially, you look at cocoa prices, which actually aren't due to interest rates. Those are actually due to some issues going on in Africa, and they just can't get enough of it. But if you look at some of these rise in commodity prices, you start to notice something. It's like the narrative was, well, higher interest rates typically leads to you should be investing in commodities. Historically, that's been the case. If you have higher interest rates, commodities were a place to put money. And you've noticed as I kind of go through this, you got gold, you got silver, you got platinum. Actually, platinum and palladium are a little different because a lot of that has to do with Russia, especially palladium, which is why it hasn't taken off. But look at copper. Copper is always known as Dr. Copper. And for those of you who are not familiar with the term, Dr. Copper is basically a weather vane for the economy. When Dr. Copper is down here, it's showing, well, maybe the economy's not doing so well. Once it starts to take off, wow, we're seeing a lot of growth. Now, this could be due to many reasons, but my point is it's an indicator you can use to look at your portfolio, to look at the economy and say, all right, why is this starting to take off? Is it because, all the copper mines have closed? That could be a reason. And then that has nothing to do with anything, right? Like cocoa prices have to do with some issues going on in Africa, which have nothing to do with anything else other than the crops in Africa, which is, I think it's like 90% of the global cocoa comes from, I think it's Western Africa. I'm not sure. I have to go look it up. But anyway, something along those lines. So that's the problem, right? It's centralized and there's an issue there. But when you see this, you have to say, why is this happening? Like palladium, why is that happening? Well, it has to do with Russia. Okay, Russia's dumping their palladium on the market. Okay, that's a good reason. So if you don't know the reason, if the reasons haven't changed and all of a sudden things start to pick up, you could say, well, what am I missing here? Am I missing some specific event, or is there something else going on that's impacting this, like the economy's growing? So these are just things to keep an eye on, right? So if you're looking, I always look at commodities just to see what's going on, like where are the opportunities, right? So if you look at energy, I know we talked about before natural gas. Well, look at that. Natural gas has plummeted. Now it's starting to pick up. Interesting. What's going on there? What am I missing? Are there opportunities? Is that something we can invest in? Heating oil. Wow, that's gone through the floor. Well, I'm going to go fill up my home. you know, like,
I will, and then think of it. And what's interesting with heating oil and natural gas, we had an exceptionally warm winter, right? So no surprise that it went down when it did. The fact that natural gas is ticking up here in May as we're going into the summer, that's a little bit of a strange anomaly. Now, heating oil continuing to plummet, not a surprise. We should see that bottom out during the summer along normal trend lines, right? Because yeah, I mean, who's heating their house in the middle of summer unless you live well outside of our country? So but to see natural gas ticking up right now could have been, and actually may be, a sign that natural gas futures overstretched because it was such a warm winter that natural gas, and you could see there on the trend line. It look, I don't know how far, I'm trying to look how far back that goes, Kirk, but
goes in the 20s.
natural gas is the lowest price has been in over 3 years, right? So did it
Excellent.
overstretch to the point in which, people realize there was a deal at that level to jump in and get it at a value, knowing it's probably going to go back up in the winter next year?
The
And
15
even,
year, I mean,
yeah.
in 2020, because of COVID, it hit a low, but it
Yeah.
went to lows it hadn't seen before
Right.
prior to
So
COVID.
we still use natural gas in the middle of summer, right? We don't use heating oil very often. That's why it keeps going. It would make sense, but you're still using natural gas for heating of your for cooking, heating of your water heaters. Oftentimes it's used in other types of industrial uses. It's used as a fuel source. There's natural gas engines out there. So natural gas is going to be one of those things that is still going to be in somewhat demand in the summer. So again, is this a trend? Where did natural gas end up in terms of its historical pricing? Did it overstretch to the wrong way and it's bounced off that bottom? Or are we starting to see a trend in the other direction in preparation for next year? Those are the kinds of things you would look at.
Yeah, so I think it's just, as we kind of go through all these, it's always important just to kind of see what else is going on. You want to see what you're missing, in looking in certain areas. You just want to make sure that you're not missing something big. And so when you're looking at your portfolio, and I'm going to change this back here, but when you're looking at your portfolio, you should always be mindful of what else is going on in the economy. What am I missing? Like, what's going on here that is not being talked about? And and I think and I want to kind of bring this topic up as well, is if any of you have noticed, and if you're not attuned to this like I am, you may not have noticed, I'm always looking at narratives. And to my point of view, understanding the narratives are really important, because a narrative isn't the truth. It's a story. It's a story that collectively we decided to tell ourselves. Like, climate change is an example. Climate change is a narrative. It's a story that we've collectively told ourselves is true. I don't know if it's true or not. And frankly, my understanding of science is nobody can tell if it's true or not. But we believe it, and so we've gone with it. It's a narrative, right? Rightly or wrongly, I'm not characterizing it right now, but that's a narrative, right? Now, ESG was another narrative, right? Environmental, social, and governance. This is a trend on Wall Street, and it was a strong trend where people were selling ESG to investors, and it was a narrative. And the funny thing is everyone on Wall Street knew that ESG was bunk. Like, everyone knew it was crap. It was just a way for Wall Street to sell, more ice cube to Eskimos. It's just the way it was. Like, there was no secret on Wall Street, but the investors didn't know. They're like, oh, I want to feel better about my investments, which is fine to feel good about your investments. I feel good about my money. I can take my money and put it into what I want. My investments are my investments. My activities are my activities, right? But some people try to cross them. And that was what the ESG was. Now, ESG was a narrative. Now, what I've noticed, and this is the interesting part, is ESG was being strongly pushed until about, I don't know, 6, 9 months ago, when there was a huge pushback, when a lot of the pensions of certain states were saying, nope, we're not, you're pushing ESG on us. I think Larry Fink was a big pusher of this. It's like, we're actually getting rid of you, BlackRock. You're done. Like, we're going to find someone else to manage our money. And so they started to get pushback, so they stopped pushing ESG. And it was, I think it was around 6, 9 months ago where that started to happen. And now you don't even hear about it. Like, it is, when you hear about it, if somebody's out there pushing it, it's because some small advisor or fund manager decided, hey, I'm going to jump on the trend, and it's too late. You missed it. Like, no one's interested in ESG anymore. I'm not saying ESG is valid or not. That's not my point. We're talking about narratives, because I know we're going to get some hate. Well, you're saying ESG doesn't work. No, I didn't. All I said was it's a narrative. And so when you look at the narratives and they change, you should be mindful of that change. Because if you miss the change in the narrative, then you're going to miss future returns. So if you look at the ESG was one, here's another one, cannabis, right? Cannabis became a big deal a few years ago, and everyone wanted to invest in cannabis stocks. The problem was there weren't any. There were a few that were related to cannabis, but it wasn't a great one-to-one thing. So everyone's like, I want to invest in cannabis. And so everyone just piled into the cannabis space, into a bunch of junk stocks, and then they peaked, and then it kind of stopped. People stopped really caring about cannabis stocks. And then the stocks plummeted, and they went into the basement. They're starting to come out now because the Fed, I guess the federal government has decided to move it from a category 1 to a category 3 drug, which means it's pretty much they don't care. I don't know if they've technically done that yet, but they've said they're going to, which may be political for the election. I don't know. I'm sure it's political, but anyway, I think it's a good idea. But anyway, it's a different story. But so what that has done is that has rekindled the fire under cannabis stocks. The stocks haven't gotten any better. They're just, it's the narrative that's out there that's pushing the money in these places. So we talk about narratives because if you don't understand the narratives being pitched, then you're going to miss out on what's happening. Here's another narrative that's changed. And Doug and I talk about this once in a while, but maybe not enough, is EVs, electronic vehicles. There was a strong narrative for years, pro-Tesla, because Tesla was really the big one. Then other car companies got involved, and they started selling EVs. Oh, and then it became a big deal. Well, what you're noticing now is actually there's the narrative around EVs has almost completely stopped. It hasn't stopped from the companies selling them, but it's almost completely stopped from the political realm. And so that's an example of where I would say, isn't that interesting? Why is all the chin wagging around this stopped? Is there a reason for it? I don't know the reason, but I can speculate what the reason is. But right now, that's all stopped. So it's like, what's going on here? Maybe I should investigate further. So anytime you see a narrative change, there's usually some underlying reason that you should understand. Because if the narrative changed, that means the amount of money going in is probably going to shrink. And it also means that if you're on the wrong side of it, you could lose a lot of money. And I'm not suggesting EVs are that way, but I can imagine that there's a lot of political behind closed doors movement of what's going on, because we've also talked a lot in the show. Hopefully we've had some headway about nuclear, which if that is the next trend, I want to be on that. I'm not sure there's a great way to invest in it at the moment, but that's a great trend. I'd want to be on it.
They just put a new nuclear facility online in Georgia, if I saw it the other day.
Yeah, it's definitely not. It's definitely not where it needs to be. Like the technology, the investments. It's like basically you're investing in utility companies, which aren't really great investments for like growth. So infrastructure is a little tough to invest in, but if you know how to do it, you know how to do it right. It is, in my opinion, that is where directionally things are going, is nuclear. And I think this gets back to my podcast topic, circling back, because I don't think I illustrated enough with Salim Ismail, where he was talking about decentralized versus centralized. And right now our economy is centralized because centralization helps protect people, and it helps centralized resources. But with the technology coming out in the next 5 to 10 years, it's going to change everything. You're going to be able to have a small nuclear reactor that's buried in the ground for your town, and it's going to be really, really cheap. You're not going to need wind power or solar power or hydropower or natural gas powering electricity. You're going to have nuclear reactors, small portable nuclear reactors, which you can bury in the ground. They're good for 20 years. They're cheap, and they give everybody plenty of energy. We're going to get to a place where we're close to free energy. Close to, not free, but it'll be close to free. And what does that mean? That means there's going to be an explosion economically. Because think of the cost, right? If I'm going to transport wood from one place to another, well, wood's pretty cheap. But if I have to transport it, well, all of a sudden the price of wood goes up 3x or 4x because of the transportation costs. But what if the transportation is close to free? Well, now everything's cheaper, right? Everything's deflationary. So the decentralization that's going on, energy is one of them, right? You've got decentralization of knowledge, right? You don't have to go to MIT. You can go to MIT online and learn the same stuff. And you could be in Sri Lanka and be really smart. And you could. Somebody was telling me that there's like an island nation that came up with a brand new technology for, I don't know, it was like EV cars or something like that. But it was something that they had nothing of. Like there's no relationship to that island. The point being is when you're decentralizing, you're allowing every single person in the world to have access to everything and to be able to provide that access to everyone. So the whole world and the economy is going to change in the next 5 to 10 years. Frankly, I don't even know how to view it. Like I listen to a lot of visionaries, and some of them I think are accurate, some are not. But I think it's really interesting to think about. So those of you who like sci-fi, you're gonna love the next 10 years because it's basically a sci-fi novel playing out in real time. Like all this stuff is gonna happen. You're gonna be like, whoa, like AI. Where I'll talk about AI. We have no idea the implications of AI. Like nobody does. We have some thoughts, but until it really happens, you really won't know. So the point is all these new technologies are converging at the same time. I mean, frankly, there's no better time to be alive right now than right now. I mean, think about it. Like all this new stuff. You've got cryptocurrency, which has solved the security problem. You've got the internet, which has allowed everybody to communicate across the world. You've got AI. You've got, potentially cheap or almost free energy. I mean, all of this stuff, it's like crazy. Like it's kind of scary too. But if you're an investor, you need to know about this stuff. You need to be not listening to investing podcasts all the time. You can, and it's important to get better investing, but it's also important to understand trends. So listen to visionaries, listen to people who are thinking about the future in different ways. That is also an important part about investing. Warren Buffett doesn't invest in this way. He's not the front end of the curve. He's the guy who's like, I want to get in when I can get it cheap and I know is a pretty predictable cash flow. The people who are buying IPOs, that's not Warren Buffett. But if you know about that stuff, it allows you to invest in areas that it gets you ahead of the curve, and it'll give you insulation for when times get rough. Because, like I like gold because everyone's always going to like gold. Like that's not going away. It's deep in human nature.
What do they say? What do they say? People like the shiny new object. Well, what do you think shiny new object relates to? Historically, that's always been gold.
Right. But now it's not. Now it's something new. But people like that. And anyway, taking it all back, and give it back to Doug here to final thoughts and wrap it up, is take the time to research future trends. Don't just take what some Yahoo tells you on Yahoo, ironically, or on any of these other channels. Take your time and do the research. Listen to experts, not investing experts. Listen to experts in those areas and think about the implications. And then when you take that information, now you can apply it to investing. And then you can listen to people talk about investing. And some of this you can be like, this person's an idiot. They have no idea what they're talking about. Or some people might say, oh, well, this is interesting. Let me think about it this way. Don't just take what people tell you and invest. It's one of the reasons we don't talk about stocks or investments on the show, in part because of compliance and I don't want to get in trouble, but also part because I don't want to give you ideas. That's not my goal here, because I can give you tons of ideas and that's not going to help you as an investor. But I can teach you how to think. That will allow you to take that framework and go out and find these ideas. And we'll point stuff out. We talked about natural gas, we talked about heating oil, and all that's fine, but you're not really investing in those commodities. I mean, that's most people are not, and I know that, and I'm not suggesting you do. But if you see those opportunities, you can say, coca prices are really expensive. What's that going to do to stocks that need coca? What's cheap natural gas prices going to do to stocks that have natural gas? Maybe there's some opportunities there. Just things to look at, and it'll allow you to identify opportunities, and then you can look at them and say, okay, this is interesting. I think this is going to be a good idea moving forward. So just some things to think about. Doug, final thoughts here as we wrap it up.
Yeah, I mean, I'm not going to, take it down that road anymore. There's definitely some things that we could kind of branch off with that. I think that there's some incredible opportunities. I did want to throw something back to you, I think, for fun, because, and again, I know you've been doing a lot of talking today, Kirk, but I know you always love chart crime stuff. So if you look, I just posted something there. If you want to pull it up, and I'd just like to get your take on it. House flippers triggered the U.S. housing market crash, not poor subprime borrowers. I love that.
Oh, there we go.
Yeah. Yep. So somehow, given all the data that occurred back during the great financial crisis, it turns out that somehow in this chart, this gentleman has figured out how to identify that obviously flipping homes, and again, using Redfin data, was the number one cause of the collapse of real estate during that time. So, there you go. I thought I lost you for a second. So, I mean, again, I can't even begin to tell you where the chart crime comes from, other than to tell you that the opinionization of taking this chart and randomly throwing out this assessment, which again was from 2017, it looks like. But again,
the whole thing's a chart crime, Doug.
It's the whole thing's
the whole thing's a chart crime. There's like 20 things in here we can pull out.
I don't even know where to begin with the chart crime on this. Exactly. So ultimately, again, it's a reminder that you see charts. It's always fun for us to come back and make fun of the fact that people will manipulate the information they're giving you at any different angle, which takes us back to the beginning of our conversation today, even to the way that they package laws, like, like the Patriot Act, right? Well, if we don't invest in that, you're not a patriot. It's all to sell you on some sort of a narrative. So always do your research and look a little bit further. Like Kirk was saying here, this is about being informed. And listen, to wrap this up, what I have found is that most people in the financial world, I'm going to give you a great example the other day. This is, I wish I could think if I can remember exactly how this, you're going to love this, Kirk. So I am listening to someone who now has 27,000, it actually might be 37,000 followers on Twitter, who does, of course, as they all say, doesn't give financial advice, but yet gives nothing but financial advice. This person who randomly puts out all sorts of wonderful education. And obviously, if you have 37,000 followers, there's people listening. Actually said, I'm buying bonds right now, and I'm holding bonds in my portfolio because I know that if interest rates go up, bonds will increase in value. I'll pause right there while Kirk puts his head through the computer. We've talked. This is after we went through 2 years of bond implosion due to rising interest rates. He is stocking up on interest rates for the next interest rate hike. And this is a person that is out there giving advice that people are listening to. So when I say this, I mean this. There's evidence of this every single day through chart crimes and through absolute fin-twit stupidity. And I will call that one stupidity because as I've said before, and we talked about today, where stocks are going, that's opinion. That's euphoria. We think the outlook looks good. Bonds are mathematical. It's black and white. And if you don't understand how bonds work against interest rates, you are in no position to give any advice whatsoever. So to wrap this up, what I have found is that financial advisor, licensed, for those who can't see, licensed, accredited, governing bodies for accountability. Finfluencer, no licenses, no accreditation, no accountability, wants you to buy their program that advises tax evasion. Yes.
I love this meme. It's great.
And even those that aren't that extreme or that, I want to say malignant, but that evident in their corruption. It just tells you how little of how poor knowledge there is out there. So listen, what I've found it is not just those people on Twitter; it's financial advisors in general. They are not if they are not understanding these trends, if they're not helping you to understand these trends, if they're not thinking about anything more than, just, well, these things are always good, so this is why we put this in the portfolio, and they're not making that tactical adjustment to based on what is changing. And we say this time is different. You mentioned it, Kirk, with AI and Bitcoin. This time is different. These are things that are fundamentally completely different than anything that was involved in the way we looked at investing over the first 100 years. Okay. So there are lots of things that aren't different, but if they don't understand it, then I am going to make this very clear. They are potentially severely hurting your retirement. And I will say the same thing about the area that I come from. If you are working with a financial advisor, most of them, if they're not helping you with college planning, they are potentially severely hurting your retirement. There are articles by Forbes, there are articles by the CFA Institute that have basically talk about the severe lack of preparation among financial advisors and understanding how to assist clients in financial college planning. There's severe lack of preparation and understanding how to understand these trends. Both of these impact. So listen, this is not just the lowest income. This is the highest income. They are finding that people at the higher incomes of affluency are finding out that they're going to may have to make decisions of telling their children that they can't go to the same college they want to, or drop out, or take huge amounts of debt, or less than they need. Ultimately, at the end of the day, it impacts estate planning goals. It impacts including unequal distributions among heirs, diminished intended legacy, and ultimately a change of a lifestyle that many affluent are accustomed to. Get the information right now. So go to our website, emergentcollegeadvisors.com for more information. Obviously, if more information and you're interested in understanding more about trends, talk to Kirk at Innovative Wealth. But either way, if you don't have that kind of advice, get the information so that you can be informed, because unfortunately, a lot of advice out there comes from a position of lack of information, and they're not qualified to be leading you down that path.
Yeah, thanks, Doug. Thanks for joining us on the show. We're going to wrap it up here, but I'm going to end the show with one point. Is I think that if you're looking at the markets now and you're confused, and a lot of people are, frankly, a lot of advisors, a lot of professionals are confused. Everyone thought there'd be a recession by now, and it's 2 years later. And frankly, everything I'm seeing leads to the market's probably going up more than going down, and it doesn't make sense to a lot of people. So if you're confused, if you're concerned about risk of the markets, you can always give me a call. That's something that we specialize in, is risk management. So as we kind of wrap it up here, we'll get into more of that next week. We got some interesting charts for next week. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.